Welcome back to our ACCA F9 course. Today is our fourth class. In the agenda today, we will cover 7 topics. We will finish the sources of finance topic, including the debt capital. We will share with you different types of debt capital, as well as their advantages and disadvantages. And also we will cover another topic is on the sources of finance, which is the impact on earning per share and financial gearing. Next, we will share with you some concepts or some products for small and medium enterprise finance. Also, we will brief the economic finance. On working capital management, we will start this topic today. First of all, we will share what's the concept behind working capital management. Next will be followed by the inventory management fundamentals, as well as we will share with you the inventory management model, one of the inventory ordering model, which is the economic order quantity. Remember, in last class, we just covered the equity capital, and today we will cover the debt capital. As a company can raise funds from external parties like the equity holders or the debt holders or the bank. Also, if it has adequate funds in-house, it can utilize or it can make use of those internal funds for the investment projects. And in ACCA F9 exam, remember the source of finance, for example, like equity capital, debt capital. These topics, the question asking for these topics are mainly the discursive questions. For example, like asking you what are the advantages or what are the disadvantages of like bank loan, like convertible loans or preference shares or rights issue. So you have to remember those financing instruments, the advantages and disadvantages for your preparation in the ACCA F9 exam. Okay, coming back for the topics today, we will share with you about the debt capital. So what are the debt capitals? Okay, debt capitals comprises of 4 parts. Okay, first of all is the borrowing from banks and institutions. So strictly speaking, a company has a bank loans or from the financial institution loans. So what we call the company has the bank facility. In general, every company, even they are large company or small SME, they can negotiate with the bank to have the funding lines or the bank facility, what we call here bank facility. Bank facility includes different instruments. For example, like overdraft. Overdraft is one type of bank facility that provides to the company for the financing needs. Also, the bank can offer term loans or revolving loans to a company. If a company is in the trading industry, for example, like trading cars, trading grocery products, or even trading foods or trading vegetables, if it is a trading company, it has some if for example if it is a trading company and the sources of supply is from foreign countries, then the bank can offer or can provide the trade finance facility to the companies. Okay, like the letter of credit facilities is the financing tools provided by the bank. So in general, bank is very important to a company, for example, like the financing in terms of debt. And next is about debentures, loan stock, and bonds. So those instruments are issued by the company directly or through the merchant bank to the to the financial markets. For example, the investment bank or merchant bank liaise different investors to invest the debentures or loan stock issued by the company. In addition, there's convertible loan stock. Though this financing, okay, has two parts. Okay, the first part is about the loan stock part. Okay, the loan stock part means the company has to pay interest to investors or to debt holders. Okay, here is the first part, interest. And when the loan stock, for example, when it has the terms behind the convertible loan stock agreement between the company and the investors, if the terms stating that the loan stock can be converted into shares, for example, $100 loan stock convert into, say, for example, 10 shares. Then it's a conversion into equity. Okay, so it's a two parts. First of all, it's the interest. The other part is the equity. We'll cover the details of convertible loan stock later. Okay, because it is also a crucial topic or important topic in the ACCA F9 exam, asking by the examiners on what's the advantages and disadvantages of convertible loan stock. Next is warrants. Warrants are the financial instruments issued by the company, which is the options for the investors to subscribe the company shares at a given price or on a given day or a range of days. So what are the advantages of debt capital? So we are covering the general advantages of debt capital here. For debt capital, it is cheaper than equity capital as it is less risky than equity capital because, okay, first of all, it has definite maturity. We know that when it is expired, the expiry date or maturity date. Okay. So what's the advantages of it has a definite maturity? Okay, it is more certain and less risk. Okay, because it is more certain for the investors to know when the company will pay the principal to it. Next, for interest payments, it has the seniority or priority for the investors as to compare to the dividends. For example, a company, okay, making profit. So what we call the operating profit is earning before interest and tax. So earnings before interest and tax, okay, we have, for example, $100 here, and then it has to pay interest first. Interest, for example, $40. Okay, so the remaining $60 may be at tax rate 30%. So here, the net profit after tax is 42. So the $42 will be distributable to the shareholders as dividends, given a stated or a dividend policy was in place. So here for interest, okay, it has no interest policy. Okay, it can only follow the rules. For example, in the loan agreement, it has to say, Okay, for how much money that I borrowed you, and how much money that I can receive from you as an interest. So here is certain, or is quite or have some priority to dividend as an equity holders. Also for capital distribution or liquidation, we know that, okay, if you guys study legal paper, you know that for when a company in liquid or in liquidation, the money, the cash by selling the assets that it held will be distributed in the sequence following, for example, like first of all to the staff, a salary first. Okay, next to those bondholders or mortgage, bank with asset-backed loans. Okay, for example, if the loans are backed by assets, then when the assets sold to the market, the residuals received or the money received has to pay back to the bank for those asset-backed loans. And third, maybe some senior loan notes. Okay, it means this note has no any asset back. And four, loans, okay, maybe payables, okay, and then a lot of others, okay, for example, like maybe finally to the equity holders. Okay, but all before that, before the staff can get the can get the salary payment, auditors or other professional advisors has to claim the money first. Okay. So the priority in capital distribution for debt holders has a priority as compared to those equity holders. Also, fixed income in respective of company earnings. For example, if a company cannot make a lot of money, but those interest payment has to be paid by the companies to the debt holders. So because of it's less risky, the required rate of return by investors is lower than equity capital. So it's cheaper, okay, in general, it's cheaper. And for dilution of control, because the debt holders has no voting right in the board meetings or in the general meetings, so there's no dilution of control for the company. So what are the disadvantages of debt capitals? Even they're making losses, interest has to be paid. Okay, it will lead to a problem of the liquidity problem. Okay, because you have to pay the interest to the debt holders. Next is about the debt capital. It will increase the company's gearing, so increase the financial risk. So when you increase the financial risk, okay, do you remember what's the impact to equity beta? Okay, in January it will be going up. Okay, it is going up. So next, with fixed maturity date is fixed, then provision must be made for repayments for that. Okay, but some company can roll over the debt, okay, by borrowing from the market or other investors. Okay, the company can roll over the debt if it is mature by borrowing the money from the market or other investors. If, for example, some other investors are interested to lend the money to the company. But there is a risk. What we call is rollover risk. Okay, if you have the debt, then if it is short-term debt, the rollover risk will be higher, given when the debt is mature, you have to find the other investors to give you money or to lend you money for your business or to operate. Okay, if you can't find any investors to lend you money, then you have the financial risk or some liquidity risk. So move on. About the debentures and loan stock and bonds. We have three terms, okay, referring to the same thing, fixed or floating rate loan, okay. And here we have two terms here, but quite similar. One is a deep discount bond. It is the loan stock paying a very low interest rate and issue at very low price below nominal value. Nominal value, given that nominal value we are given is $100, okay, and redeemed it at nominal value. Investor get return from capital gain. So deep discount bond means it's still interest, but very low interest payment. In addition to deep discount bond, we have zero coupon bond. For zero coupon bonds, it is the extreme case of deep discount bond. For example, there's no interest payment for the bond issue. So the company only issue the bond, okay, at a price well below the bond par value. Okay, in general, par value or nominal value is $100. For example, if the nominal value is $100, then the company may issue a 10-year zero coupon bond. For example, at market price, say $40, but the par value is $100. So it's a zero coupon bond. So what are the advantages of zero coupon bond or deep discount bond? The deep discount bond advantage is no financing cost because in the financial statement, it pays very low interest to the investors until redemption. It fully pay back to the investors. It is very suitable for those startup situation like a new project. Okay, it has no or insufficient cash flow or cash inflow in the initial stage. So once the company would like to invest this kind of project and then raise funds through deep discount bond or zero coupon bond, then it has it can reduce its financial risk. I mean the liquidity risk in the initial stage. And if the project is really success in, say, for example, 5 or 6 years later, then it generates a lot of cash flow so that it can repay the loan. But the disadvantages is if the project is unsuccessful, then the company has no money to pay back the bonds because in the par value $100, okay, is agreed initially, and the company has to generate sufficient cash flow in the long run to repay back the bank loan, the bonds. So for deep discount bond and zero coupon bond, the advantages, okay, is has less or very low financing cost initially, Okay, and also it's very good for project with the startup situation. On the initial cash on the cash flow is very limited in the initial stage. So next is the convertible loan stock. For convertible loan stock, the loan stock which gives the option to convert into shares, into ordinary shares. Okay, here, remind you into the ordinary shares at a given conversion ratio on a specific future date or range of dates. If the option to convert is exercised, okay, what does it mean, exercise? It means the option investors has used the option to convert the share. So it means in the financial terms, what we call is the option is exercised. Okay, the option is the right. The option is the right to investors, but not the obligation to the investors. Okay, it's very different. We will go through in details in the risk management to differentiate between what is option, what is future. And here, the option is the right to buy or sell the asset, but not obligation to buy or sell. Okay, here is the key words here. It's the right but not obligation. And in convertible loan stock, it is a loan. Okay, plus an option. It's a loan and an option to investors. So remember, it has two parts. Okay, for loan, it has the loan value, right? For an option, it also has an option value. So if you are investors, do you require a higher required return as compared to the single loan stock, or a lower value for it? Okay, because you have an option. You have an option. So this option has some value. So to you, you are required the rate of return a bit lower if it is only a single loan. Okay, because you have an option, it has a value for you. So in general, it is preferred by a company to lower its interest cost. So as mentioned, it's a conversion ratio, so it's an option. So what's the this option premium or conversion premium? Okay, it means the option value. Here is the option value. Okay, it's the difference between today's market price of the loan stock and today's market price of equivalent share. Okay, remember its option value or it's only the option premium is, for example, today's market price of loan stock, say $90. Okay, maybe say the loan stock can convert into 10 shares, and current market price for shares is $11. Okay, so total market value or the market price for equivalent shares is $110, and your loan stock value is only 90. So the difference, the conversion premium is 20. Say is the same. Okay. And what's the advantages of the convertible loan stock? Okay, interest payable is lower than normal debenture. As I said, okay, because you have the right to convert the loan stock into shares. So if the right has the value, okay. But so that because of the value of the right, so that you can accept a lower interest payment from the company. And also it is a method of issuing delay equity. So initially, the dilution of control will not be happened until the convertible loan stock investor would like to convert the loan into shares at a later stage. And what's the advantages of convertibles to investors? So be careful here. The first part is the advantages to companies. So interest payable is lower interest. Okay, it's cheaper loan, and also a method of issuing delay equity. So no initial dilution of control. But for convertibles, advantages of convertibles to investors is different. Okay, the investor has the right to invest into the company as equity holders at a cheaper price, because the company would like to attract potential investors into the company by, for example, to lend them money by issuing the convertible loan stock. And the condition is the option or the rights to convert into shares is attractive enough for those investors. Sometimes the conversion ratio is very benefits to those investors. For example, if the current loan stock market value, say $100, and equivalent to 10 shares, and the market price per share is $10. So initially it's the same. So it seems to the investor that the option value is zero or very low, or the price is very low. Then it is very attractive for the investors, because it has the right to convert if it finds there's a profit or capital gain opportunity by convert the loan into shares in future. Okay. So to investors, it is an opportunity to invest in the equity investment at a cheaper price if the company is successful. And also, if the company is not successful, it is a loan, because in principle, it is a loan. It can redeem the loan if the project or the company is not very successful. And the valuation of convertibles, we mentioned that the value of convertible is between it's about the conversion premium, okay? But here, what we call is the value of convertible is the higher of either its value as debt or its converted value. Okay, this is known as formula value. Okay, so you have two options here. You have to work out two valuation. First is to work in the debt value right now. For example, you work out the debt value here today is $96, and the convert value means all shares all loans will be converted into shares. Say is $100. Okay, then $100 is the market value of this convertible loan stock. Okay. So move on is about the warrants. Warrants are warrants on principle. It is an option, okay, issued by a company to for the investors to subscribe the company shares at a given price and a given date or a ranges of days. And the warrants will be exercised if the exercise price is less than the current market price per share. If the warrants are exercised, the company issues new shares. Okay, what does it mean? Here in this example, you can check it out in the notes. For example, the share price right now is £10. And the exercise is the current share price. The exercise price is 8.75. So the value of the warrant is the difference between existing share price and the exercise price, which is £1.25 here. Okay. So here is the price for the warrant today. Maybe okay. Even you are in the F9 course, you no need to work out any formula or any advanced financial management tools to evaluate an option pricing. But here, okay, just the concept, the difference between share price and exercise price, okay, gives you is the option price or the warrants price. And here the warrants price, you have to pay now, then you can have the right to buy the shares at 8.75. If the exercise price is higher, for example, here, when it's £10, £10 is higher than 8.75, right? If in opposite right now is only £7. So you won't exercise, right? Because it is lower than the exercise price. So this case, you won't exercise. So next is about the international market. There are two terms, but I would like to explain into one single terms. Okay, for Euro currency market or Euro bond market, Euro doesn't mean Euro. Okay, what does it mean? Okay. Euro doesn't mean Euro. What does it mean? For Euro currency or Euro bond market, it means any financial instruments like bond, like long notes, okay? These financial instruments, okay, their currency, the denominated currency, is in foreign currency. Okay, so for example, in London, okay, London is a world-class financial market. A lot of financial instruments are traded in London, no matter they are domestic, like the financial instruments issued in domestic market in terms of sterling pounds, or other foreign or other financial instruments denominated in other currencies like US dollars. They are traded in London. For those denominated in foreign currency, like the US dollar bonds traded in London market, when issued in London, for example, in London, you can issue a US dollar bond or US dollar loan, but in London, not in US. Then it is what they call is the Euro bond. And for Euro currency, in the international market concept, okay, it's more or less the same. For example, you borrow money in a UK bank, in a British bank, but the money you borrow is not in terms of sterling pounds. For example, you borrow US dollars in a UK, in a British bank in UK, then those money you borrow, they call it Euro currency. Okay, so Euro bond or Euro currency, okay, traded in London. Okay, they don't mean that all those bonds are Euro, are denominated in Euro. Maybe Euro is one kind of financial instruments. But for example, if you would like to raise money in London, by asking the investor in London, or you issue the bond in London, but the denominated currency in US dollar or in Canadian dollar or in Australian dollar, all those financial instruments are called Euro bond. Okay, I hope you understand.